Well, good morning, everyone, and I hope you are all safe and well, and thank you for joining our webinar. My name is Kim Kellaway, and I'm Head of Clients at Markets at HLB Mann Judd, and I will be your moderator for the day. Today, we are presenting Financial Reporting Update in a COVID-19 environment. Our presenters are Michelle Warren, Carmen Ridley, and Aidan Smith. Now, a little bit about our presenters. Michelle Warren is our Director of Financial Reporting Australasia at HLB Mann Judd. In her role as Director, Michelle provides leadership on financial reporting matters across the HLB Mann Judd Australasian network. Carmen Ridley. Carmen is the Principal of Australian Financial Reporting Solutions, an independent financial reporting consulting business. She provides training and consulting services to a range of small to medium accounting firms and entities in the for-profit and not-for-profit sectors. And then we have Aidan Smith, our Partner, Audit and Assurance. Aidan has extensive audit experience and is highly respected for his knowledge of accounting and auditing standards. He is also the head of our HLB Mann Judd's Australasia not-for-profit group. The presentations will go for approximately 40 minutes, at which time we will then open up to questions. So please use your question box in your Zoom control panel, and then our presenters will answer your questions. So I would now, without further ado, I would like to hand it over to our first presenter, which is Michelle Warren. Thank you, Michelle.
Thanks, Kim. And hello to everyone that is tuned in this morning. So with everything that's happened over the last few months and the speed at which developments have been unfolding, it is not easy to be across all the relief measures that are currently in place and know who they apply to. So I thought it would be worthwhile to just spend some time talking about the key relief measures that have been offered by regulators to assist entities in meeting their financial reporting obligations in this very challenging environment. Next. So let's start with for-profit entities and the relief around annual general meetings. So this would be relevant for listed and public unlisted entities. ASIC will not take any action if public companies with balance dates from 31 December 2019 to 7 July 2020 do not hold their AGMs within the usual 5 months after year end, as long as they are held within 7 months after year end. So in effect, a 2-month extension. For example, if you have a 30 June 2020 year end, usually you would have to have your AGM by 30 November this year, but under the relief, you will be able to hold your AGM anytime up until the 31st of January 2021. And this is the case even if it means you do not have at least one AGM during the 2020 calendar year, which is normally required by the Corps Act. So in response to the restrictions on large gatherings, the Treasurer has temporarily amended the Corps Act to facilitate virtual AGMs by allowing company boards to provide notice of AGMs to shareholders via email, achieve a quorum by reference to shareholders attending online, and hold AGMs online. What's important to remember is that these virtual meetings continue to provide shareholders with a reasonable opportunity to participate. So, for example, they must be able to put questions to directors online, and they must be able to vote online. Where relevant, in a few of the slides, you'll see I've included some references, and those are just some handy references should you want more detail on any of the subject matter I speak on today. Next. All right, the second relief measure I'd like to mention, still for for-profits, this relates to extended lodgement periods for financial reports. So keep in mind that ASIC has issued 2 lots of relief. The first announcement was made in early April, the 9th of April to be exact, and that was only aimed at unlisted entities with balance dates from 31 December 2019 to 31 March 2020. while the second announcement, which was only made just last week, it included both listed and unlisted entities and essentially extended the lodgement relief to include 30 June 2020 balance dates. So what I've included on this slide and the following two slides is an overall position taking into account both announcements. So what is the relief? Well, ASIC has granted listed and unlisted entities an additional 1 month to lodge their financial reports. So to be eligible, your company must lodge financial reports under either Chapter 2M or Chapter 7 of the Corps Act, and it must, the balance date must be from 31 December 2019 up to and including 7 July 2020. If your statutory deadline had already passed by the date that either instrument was officially registered, you will not be able to apply this relief. So let's just quickly work through this for 31 December 2019 reporters. For listed entities with 31 December 2019 balance dates, this relief cannot apply to you because ASIC's initial announcement did not include listed entities. And under the later relief, or the May relief, your full year and half year statutory reporting deadline would have already come and gone. However, for unlisted private companies with 31 December 2019 balance dates, the 1 month extension will apply to you under the initial relief announced in April. So your new reporting deadline in this case is 31 May and not 30 April 2020. With respect to grandfathered large proprietary companies, these entities are not required to lodge financial statements with ASIC, but they have to have their accounts audited within 4 months after year end. ASIC has confirmed that these entities will also have an additional month to complete their audits. However, disclosure must be made in the director's report that the ASIC relief has been applied. Next slide. So I've summarized the extended lodgement periods per type of entity on this slide and the next slide. Probably the most relevant one on this slide is the proprietary company extension from 4 months to 5 months. Listed entities out there, take note of the extension from 3 months to 4 months. And that's really for our listed clients that have got 31 March or 30 June 2020 balance dates. 31 December 19, well, it probably doesn't apply to you. You would have lodged everything anyway. On the next slide, I've summarized the extended lodgement periods for AFS licensees. So please take notes if this is relevant for you. Moving along to the next slide. The third and last measure for for-profits that I'd like to mention relates to temporary flexibility under the Corporations Act. So on the 23rd of March this year, the Australian government enacted the Coronavirus Economic Response Package Omnibus Act 2020. It's quite a mouthful. This new legislation is designed to lessen the economic impact of COVID-19 and to ultimately avoid unnecessary insolvencies. So the response package did include a number of responses to the crisis, but the one I want to specifically mention today is the softening of the insolvent trading provisions under the Corporations Act, which effectively provides for a 6-month moratorium on directors having personal liability for trading whilst insolvent. So the way that this works is that a breach of duty to prevent insolvent trading does not occur if the debt is incurred, number 1, in the ordinary course of business, number 2, during the prescribed 6-month period, being the 25th of March to the 25th of September 2020, and number 3, before the appointment of any administrator or liquidator. Very important to note that this is by no means a get out of jail free card for directors. The purpose of this temporary economic measure is to facilitate the continuation of businesses during the 6-month period and hopefully allow them to return to viability once the crisis has passed. It's not aimed at those companies that would have been insolvent anyway. So if directors wish to rely on this temporary safe harbor measure, they must make sure that they have evidence that suggests a reasonable possibility that the debt was in fact incurred in the ordinary course of business during the prescribed 6-month period and before the appointment of an administrator or liquidator. I will remind debt directors that the obligation to prevent insolvent trading operates alongside the general duties of directors arising under the Corps Act. So these general duties are not trumped by this temporary safe harbor measure. I'd also just like to highlight that this temporary safe harbor measure has got no impact on the financial reporting requirements relating to solvency declarations and going concern. So despite the softening of the provisions, the relaxation of these rules, directors are still required to make and sign solvency declarations, and they have to make an assessment of the entity's ability to continue as a going concern. And I guess solvency is not something we should be thinking about once a year anyway. It's something we should be thinking about way more frequently. Moving on to not-for-profits, I'll start with lodgement relief. So for those not-for-profits that are registered with the ACNC, you normally have 6 months to lodge your annual information statement. And the ACNC has now given a blanket extension that applies to all annual information statements due between the 12th of March 2020 and the 30th of August 2020, with the new due date for submission being the 31st of August 2020. So for our clients, for our not-for-profit clients that have 31 March or 30 June balance dates, at this time there is no extended deadline for you, but the ACNC will continue to monitor the COVID-19 situation and announce further extensions where this is warranted. Charities that were affected by the bushfires and were granted an extension to May 2020 to submit their AISs, this blanket relief that I've just spoken about applies to you too. Still with lodgement relief, but for those not-for-profits that are not registered with the ACNC, but report under the Corporations Act, so companies limited by guarantee, ASIC's 1-month extension that I discussed earlier will apply to you. So that would mean that your lodgement period has been extended from 4 months to 5 months, where your year end is somewhere from 31 December 2019 to 7 July 2020. Next. Moving on to AGMs and other meetings of not-for-profits. As I'm sure many of you will know, physical distancing restrictions and delays in having accounts audited or reviewed are making it pretty difficult for not-for-profits to hold their meetings, including their annual general meetings. So ASIC and state and territory regulators have taken steps to assist not-for-profits in this regard. For those not-for-profits that operate as companies limited by guarantee, I've already discussed ASIC's no action position on AGMs and the use of virtual meetings, so that relief would apply to you. For those not-for-profits that are incorporated associations, the relief surrounding AGMs will differ depending on which state or territory you're in. If you have not already done so, I strongly encourage you to visit the ACNC's website. It has a dedicated COVID-19 page that has links to the various regulators' web pages that set out their specific AGM relief and actions that entities may have to take to be eligible for that relief. So some regulators, for example, are offering relief on an application by application basis, whereas other regulators are offering a more blanket type relief. So I do encourage you to visit the ACNC's website if you have not already done so. Probably worth mentioning is that where not-for-profits do decide to push ahead with their AGMs and hold them virtually, it's probably a good idea to check that virtual meetings are in fact allowed by your governing document, as well as state and territory regulation. If they don't, you may have to explore the process to change those rules, which may entail seeking professional advice. In any event, where you are making decisions that are different to how you would normally run your AGM, for example, it's a good idea to document these decisions. Make sure your responsible people are aware of them and communicate them with your members. And this would probably hold true for any unusual decisions that you are making in the current environment. The last measure for not-for-profits that I'd like to mention relates to compliance with certain governance standards and external conduct standards. So charities are facing unique challenges as a result of the pandemic, and it's making it difficult for not-for-profits to comply with certain obligations arising under the ACNC Act and other legislation. So the ACNC has acknowledged this, and it's taken the position that it will not investigate certain breaches of governance standards and external conduct standards that happened between the 25th of March and the 25th of September 2020. So currently there are 3 circumstances where this no action position applies. Firstly, where a charity operates outside of its charitable purpose. Secondly, where a charity incurs debts such that it becomes insolvent while still operating. And thirdly, where a charity is unable to obtain reporting from its overseas operations or partners. Again, important to highlight that the ACNC's short-term no action position is very much conditional. So for example, if we just focus for a minute on the second circumstance, operating whilst insolvent, the way that this measure operates is quite similar to the way that the Corpse Act relief measure under the economic response package works. So charities wishing to rely on this temporary safe harbour measure will have to prove that the requirements have been met. That is, that the debt was incurred in the normal course of operations within the prescribed 6-month period and before an administrator or liquidator was appointed. Furthermore, the charity would be required to ensure that its responsible people are aware of the situation and that they have an achievable plan to operate through the crisis. So just a reminder, despite this temporary period of relief, charities still have a duty to inform their members and the ACNC if they are operating whilst insolvent. I think the bottom line is, if any of these circumstances apply to you, it's worthwhile visiting the ACNC's website to make sure you understand the conditions on which no action will be taken and make sure you meet these or take the necessary steps to meet these. That's it from me. I'll now hand over to Carmen, who will highlight some financial statement areas that could be impacted by COVID-19.
Excellent, thanks Michelle. So I guess just the normal disclaimer that this is just obviously for training purposes, everything that we are talking about today. So if we look at the financial statement impact, it's a really interesting area because it depends. Like a lot of things that we say, we've got some entities that this is the best thing that has ever happened to them, this particular pandemic. We've got numerous other entities that it's not so great. So consequently, I can't tell every entity what the impact is going to be in the financial statements, but what I have done is picked on a few areas that possibly you may not have thought about, or just to expand on a few that maybe you have thought about. The first quote I initially stole, I think it was from an international board member who said it years ago, nothing to do with COVID. And he said that other than cash, everything in the balance sheet has some sort of estimate, judgment, and assumption. And that's a really great place to start when we're thinking about what the financial statement impact of COVID is, because every estimate, judgment, and assumption that we've ever had has been thrown in the air, shaken around, and dropped on the floor. Where we are today is not where we were 3 months ago, it's not where we were 6 months ago. So consequently, models that we developed need to be looked at. So if I talk through each of these boxes I've got there on the slide, not necessarily in any particular order, we'll start off with provisions. We have never seen very many onerous contract provisions over the last few years. I think we might start seeing them. This is where potentially we've had facilities that have closed or revenues have dropped significantly, yet we are still locked into paying supply contracts, for example. It could be leases that we have had. We may end up with onerous contract provisions because it's actually costing us more to be in that particular supply contract than the revenue we're getting from it. Restructuring provisions, unfortunately, we are seeing that businesses are having to close certain components, certain divisions. We're seeing that we're having to make redundancies, and therefore we need to look at whether we should be recognising a restructuring provision at our year end. Make good. Hopefully you're all recognising a make good for your leases, but you may well have thought that your lease was going to stay around for 5 years. Everyone's working home quite comfortably, and I've heard lots of people who've said to me, you know what, when our lease expires, we may not be renewing it, or we may not renew exactly the amount of space that we had. So therefore a make good provision that we had scheduled in and calculated for 5 years' time now might need paying out in 12 months' time or 9 months' time. Therefore, the calculation around that make good provision is potentially quite different. We'll talk about leases, particularly with what the International Board have done on the next slide as well. Foreign exchange balances. Obviously, if you do have any foreign exchange transactions, you would be aware that you have to translate them every year. That's fine from a balance sheet perspective. We just use that closing rate. But what about a P&L perspective? Traditionally, we've used an average rate. And in many cases, the average rate has been a fairly long period that they've used for the average. Foreign exchanges have gone haywire again over the last few months. So potentially when we're looking at that average rate, the period that we're taking the average over is much shorter. We might even not be able to use an average rate. You might have to look and use the rate at the date of transaction. So again, just be aware that what you've done in the past isn't necessarily the same as what you can do today. Economic stimulus packages, we have seen quite a number, some of them from state governments, some of them are from the federal government. How do we account for those? There currently is differing views. Michelle and I sit in a number of technical discussion sessions, and it's been raised at pretty much most of those that we sit in around how do we account for things like JobKeeper, how do we account for the PAYG credit? And even amongst the technical people, there are very differing views on this. What we've got is the AASB staff are looking at putting together some frequently asked questions. There's already been some released, and they are working on some guidance around accounting for these. It's Australian specific, therefore we can interpret the standard. What we're likely to see is a different answer for the not-for-profits and the for-profits, because the not-for-profits are likely to be within AASB 1058. The for-profits are likely to be within AASB 120, and there is some choices available within that standard. So it's not as simple as you might think about those packages. Just to be aware of it, watch this space for when those frequently asked questions are issued. They won't have any authority, but certainly there's some great guidance to look at around that. If you have any deferred tax assets recorded on your balance sheet, you were making losses, you were turning things around, things were looking fantastic until COVID-19 hit. Just because we believe that those deferred tax assets were recoverable in a previous period does not mean that they are still recoverable today. So I would doubt that anybody should be recognising deferred tax assets that they didn't have, unless you're in one of those industries that is going great guns. But don't forget that if you have got any deferred tax assets on the balance sheet, you may find you have to write them down. Which leads us beautifully onto impairment, probably the most obvious impact that everybody's been talking about. The really important thing to remember about impairment is it depends on what asset you've got to which model you've got to look at. So if we've got our tangibles, our intangibles, our right of use assets, we are in the impairment of asset standard, AASB 136. That involves us looking at impairment indicators. Pretty hard to argue for most entities, I would say, that you haven't had an impairment indicator. So that means you are going to have to go through and estimate what your recoverable amount is. You might not have done that ever, because you might have just said we don't have any impairment indicators. So recoverable amount is the higher of the fair value less cost to sell and the value in use, which is a discounted cash flow. How do we know what our discounted cash flows are going to look like? We've got to guess. We've got to use some estimation, and I'll talk about disclosures coming up. So there's potentially a significant amount of work in trying to come up with some sort of reasonable assumptions to justify the carrying amount of those assets. If we move on to the receivables, remember that last year we got AASB 9, our new financial instrument standard, and that introduced an expected credit loss model. So that requires us to guess effectively what our impairment is going to be at day one. We don't have to wait until we've got objective evidence of an impairment. We have to have some sort of model that we're using to make that assumption earlier. We've just seen the big four banks who have released their half-year results at 31 March. They have obviously got some huge models for their expected credit loss, and what they've done is they've put a COVID overlay on it. So they've said we've got our normal model, but our assumptions and judgments aren't the same as what they were when we developed that. That COVID overlay model has varied from $0.8 billion to $1.6 billion. We aren't talking about small numbers when we're talking about potential impacts of COVID-19. Now, I know that most of you listening are not from a big four bank, but please be aware that when you are looking at your receivables, you may well find that it has significantly increased your expected credit loss provision because the risks that we're looking at within our receivables and within our database have changed. From an inventory perspective, again, depends on what the inventory is. We are seeing a switch in spending from luxury items to more essential items. So if your inventory is related to luxury items, potentially we are going to see some write-downs because in order to sell them, you're going to have to drop the price. If they've got a use-by date or an obsolescence type date in there, again, we may see some NRV provisions, and that's in accordance with the inventory standard. If we move on to valuations, two different things I want to talk about with valuations. The first is in relation to investments. Now, we know that the value of investments has dropped significantly. If you've got a listed investment, it's easy to get the figure. You just log on to the website of the relevant exchange and we can work that out. What about if you've got an unlisted investment? We know that AASB 9 tells us that we cannot hold those investments at cost. We've got to hold them at fair value. How do we get the fair value of an unlisted investment? Again, fair amount of work to obtain that. Infrastructure, property, plant and equipment. If you are holding that at fair value, chances are you're going out to engage a valuer. We are seeing some very significant disclaimers that are coming through in valuation reports. We're seeing valuers who want to give us a range. We can't accept a range for financial reporting purposes. We need a single figure. So some really significant discussions have to happen with valuers. We've got to both challenge the valuation methodology and also look at it and say, is it reasonable based on what we're understanding, based on what the current scenario is, and is it very clear what assumptions have been used? In respect of employee benefit provisions, it may go up, it may go down, depends on what we're telling our employees to do. However, it is probably moving in a very different way than it's ever moved before. So thinking about how are we tracking the movement in those employee benefit provisions, both from an annual leave perspective and a long service leave perspective to make sure we've got accuracy over that. We've obviously got new revenue standards from a for-profit space. We had them last year. The not-for-profits are implementing them this year. If we think about AASB 15, that relies on having an enforceable contract. If we've got a force majeure clause within that contract may no longer be enforceable. Potentially you are outside of the scope of AASB 15 and therefore a very different revenue recognition. If we're giving refunds for change of mind because we can't supply a service, potentially that will affect our variable revenue and therefore we're having to reverse revenue. If we're in an industry that is awarded bonuses, for example, if you finish early. And we thought we were going to get that bonus because we always finish early. We make sure we do. We're after that bonus. And you'd been recognizing that revenue as you'd been spreading it over time. You may not be able to be finishing early now because of the current scenario. So therefore, potentially we are going to see reversals of previously recognized revenue. From a share-based payment expense perspective, we would estimate the share-based payment expense based on the number of instruments we believe are going to vest. If share prices have plummeted, the number of instruments that are going to vest may well have plummeted, as I can buy the share cheaper from the market rather than through this particular employee incentive plan. So we may see some changes to those expenses. From a contingent consideration perspective, this is where we've bought a business, and the business, we paid $3 million and we would pay you $1 million if everything was wonderful and everything had been increased in 3 years' time. Everything was wonderful and we were going really well until COVID-19 hit. So we recognized a provision for that contingent consideration. Is that still appropriate? Do we need to revise that? And obviously overlaying all of that is going concern. So the items that I've spoken about are on an individual level. Going concern covers everything in your financial statements at a bigger picture level. So I mentioned that we would talk about leases. So if we can click on, please, Kim. The International Board received some requests about leases because we are seeing rent abatements, we are seeing rent deferrals, we are seeing rent reductions, and we've obviously got a new leasing standard to deal with. If any of you have spent any time in the new leasing standard, you would know that to modify a lease requires a fair amount of work from an accounting perspective. So what the International Board did is they published an exposure draft with a very short comment period. It only had a 14-day comment period, which ended on the 8th of May. And they said we will give a practical expedient for if a lessee has been affected by COVID-19. And we will say that they do not need to assess whether the lease is a modification. In most cases, any changes can be accounted for as a variable lease payment. The International Board met on Friday, UK time, and we therefore over the weekend got to see the results from that. They have agreed that they are going to publish this as a standard. They've made some slight amendments to it. So it was referring only to if you've had rent reductions in 2020. They've now extended that to 2021. And they were asked to please give some relief for lessors. At this point in time, they had said no. So there's a lot of pressure being put on the International Board. We may see some changes in the next couple of months, but at this point in time, there is no changes for lessors. The board have said that the standard will be released by the end of the month, which is insanely quickly in standard setting terms. We will then, as an Australian board, look at that. We will vote out of session. We do have a meeting at some point in June, but we will vote out of session and get that out as soon as we can in the Australian context. There are some great examples in the staff paper about how to deal with these from an international perspective. So have a look at this if this is going to impact you. But I guess my key message is don't spend ages trying to work through whether this is a modification, because there is a standard that gives you relief from that. Next slide, please. If we look at the ASIC focus areas, now when they released some ASIC FAQs that I'll talk about, they kind of slotted this bit in the focus areas. We do understand that ASIC is still going to publish their normal media release and likely to be again towards the end of the month. I just thought it was worth talking about it here in respect of where they believe the areas are in relation to COVID-19. You will see very similar to what I've just been talking about on the previous slides. I'm not going to spend the time working through them, but it's worth having a look at these, certainly when you're talking to your directors and saying this is what the corporate regulator has said we need to think about. It should be a discussion on your agenda for the board meetings when you are talking about financial statements, when you're talking about the financial results. What have you done about each of these in particular where they are relevant to you? But watch this space for the real focus areas that they are putting out at the end of the month. What I wanted to do now is just pick on a couple of their FAQs, and I would strongly recommend that everybody, even if you're not governed by ASIC, have a look at these FAQs because they are really well written and they cover a significant range of topics. I just picked two of them to talk about. The first one is in relation to disclosures, and one of the questions was about what do we disclose in relation to COVID-19, because we kind of don't know anything that's happening. And it comes back to that point I made at the start around estimates, judgments and assumptions. So ASIC have said when you are dealing in your financial statements, please make sure that you tell us what you've done. We need to have the best disclosures that we've ever had. We often see very much boilerplate disclosures. We need to talk about what has happened specifically in your organisation. How did you decide on the assumptions that you used? Did you decide that everything was going to reopen at the end of August and therefore all of your assumptions are based on that? Did you decide that they might open at the end of August, but we're probably only going to be at 50% capacity until the end of the year? Disclosing information about that is going to be absolutely crucial. We are often asked, can you give us a blanket disclosure to include? No, we can't, because the answer is very truly, it depends. We haven't seen a huge number of disclosures in financial statements around COVID at the moment, mainly because in Australia, our year ends are traditionally June. We don't have that many Decembers, and Decembers were probably signed off before this really all happened. We don't have very many Marches. We've seen a few from overseas, so New Zealand are generally March year ends, but what I would suggest you look at is the ASX website, because continuous disclosure rules mean that if you are impacted by something, you have to announce to the market, and we are seeing lots and lots of continuous disclosure announcements about COVID. So it gives you some words around what we're seeing in that listed space. There's some really good announcements out there that give away information that should be in the financial statements ordinarily, instead of just being a blanket type disclosure. We should also make sure that any assumptions being used are being challenged internally, because they certainly will be challenged by your external auditors. The last one I just wanted to talk about was another comment that ASIC put in, and I put this in because it was a bit unusual, and I had to read it a couple of times when I read it. And what they said is that everything might be looking great for you. You might be looking like things are the best ever, but just think about how sustainable that is. So for example, let's say we'll use the toilet roll manufacturer. You were a toilet roll manufacturer and everybody panic bought toilet rolls for whatever reason. Your sales looked fantastic, but toilet rolls don't go obsolete. We can only use a certain number of toilet rolls. So therefore your sales are probably going to drop more towards the end of the year. So therefore, what ASIC have said is where you have had increased revenue or you've had reduced expenditure, just think about, is that sustainable and what that means going forward to you. The example that they've given about reduced expenditure is suspension of elective surgery. So your costs have dropped, but you know that you have liabilities there because you know there's lots of people who are needing this surgery, and therefore you do have a liability for that. So slightly different switching around on that. While things might have looked good, just think about how sustainable that is going to be. So I'm just going to hand over to Aidan now, who is going to talk us through some audit considerations.
Thank you, Carmen. And speaking of the toilet paper, if anyone wants to buy 40,000 rolls of toilet paper, please contact me in the chat box below. Made some bad investment decisions with these last month. Anyway, now we want to talk to you about some of the audit considerations in relation to COVID-19, how the audit's going to be performed this year. So if we go on to the next slide, please, Kim, I'll talk about a few of these. The first one's obviously how the audit's going to be performed. In the past, we've come on site and performed your audit. This year, we're not sure. If we are going to become on site, we obviously have to make sure that our staff are going to be auditing in a safe environment. Our HR department's made us very clear of that, so we take that very seriously. We'll ask for you to provide sign-off that a safe environment will be provided to our staff, and that includes social distancing as well. So it's very important that is the case, that their staff do have that, the environment provided with them that's safe. Also in relation to that, there'll be a number of audits that we'll be performing off-site. We've been doing that the last couple of months, and that does have some inefficiencies, but with technology these days, we're finding we're doing that, we're doing that pretty well. But what it means is that with some information that you can provide online and some that's provided, you have to go into the office, your own office, to provide that, scan it and upload it. What we're finding is that the audit, when we might have been out for a week, 2 weeks and got the audit done, sometimes it's taking, it's now taking a bit longer over a period of time. So we'll do some work, leave some outstanding questions, and then do some other work a few days later or the next week. So because of that, we're going to be talking to you about timetables when we have our planning meetings and agreeing these timetables up front. We just wanted to communicate it's very important that these timetables are kept to, just because the nature of what's happening with COVID and the impact it's having on us. If we agree that everything's going to be available on a certain date, or certain information is going to be available on a certain date, if you think there's going to be any delays whatsoever, it's really important that you let us know as soon as possible so that we can look at our scheduling. Now, Carmen talked about maybe the risks in the audit areas to look at. Carmen stole a quote from some of the international standards boards, and I'm going to steal the quote that Carmen stole about, other than cash, every item in the balance sheet subject to significant assumptions now. And that's, I just want to remind you of the issues that Carmen spoke about. Fair value. So fair value is just really different. If in the past you might have done your own valuations on certain things, you might have maybe getting valuations every 2 or 3 years on like properties, unlisted investments, and then rolling them forward yourselves in the current year. What we're saying now is that you might not be able to do that anymore. You might have to look at these valuations, get valuations now that you wouldn't have had in the past or you weren't expecting to get this year. You've got to look at what the valuer is saying in relation to this, make sure it's reasonable. As Carmen said, you can't just make sure you can't just have a range there. If there's a range, you've got to talk to the valuer and say, look, we need a fair value here. Okay. Impairment's just, there's going to be a lot more assets that might be impaired that in the past weren't impaired, and you've got to consider those as well. And going concern, there's a lot of, with the cash flow issues now, what you forecast last year, what you're forecasting in December, January, February, very different now. So you've got to look at that 12-month period from when the accounts are signed. At least that is also the foreseeable future. Beyond that, you can't just look at and say, oh, 12 months in one day, we're fine. You've got to look beyond that 12-month period, but it's at least that 12-month period from the date the accounts are signed that you have to have a look at. Okay. It's really with all this level 3 investments, what level 3 is under AASB 13, that's the valuations where the inputs aren't highly visible. So your listed shares, they're okay. So the unlisted shares, it gets a lot more difficult. So what we'll just make sure is that if you are having these issues, you've got these things you've got to look at them early on. Okay, it's really important that you look at this before the 30th of June. So if there are any tricky areas, any difficult conversations that we have to have or you have to have with your board, that we can tackle these now so that it's not something that's been rushed towards the deadline. Our audit report. So the impact on our audit report because of this, we're probably going to see more emphasis on matters. Now, emphasis on matters is not a qualification. It's a note which draws attention to a particular note in the accounts. So it's a paragraph in our audit report which will say, hey, have a look at this note in the accounts. It typically comes up with going concern. If there's a going concern material uncertainty, our audit report under auditing standards has an emphasis on matter saying, have a look at this note here, it talks about going concern. That could also be the case in the case of valuations where there's significant judgments and estimates that are involved when making these valuations. So the audit report might have an emphasis of matter telling you about, telling the user to have a look at a note that contains the significant assumptions and judgments used in valuing property, unlisted investments, whatever it is. Okay, these aren't qualifications, as I mentioned earlier, but they are something that could appear in our audit report. Modifications, which are qualifications, could arise. We'd hope that they wouldn't. That could be if there's no way to assess, for example, no way you can assess the fair value of something. If it's just you can't get it done or a valuer says we can't do it, then if you can't assess it, or a valuer can't assess it as auditors, we might not be able to assess it either. We might not be able to have reasonable audit evidence, that sufficient appropriate audit evidence that that asset is valued correctly. Communication, that's vital during this period, and we are finding it with talking to the clients we're working on for audits that are going on just now, and talking to our staff as well. If there's any issues that you're coming across, for example, after the presentation today, you're thinking there could be some issues that you hadn't thought of, reach out to us if you've got any questions. Just do it as soon as possible, so that if we can tackle these areas on a timely basis, and that we're not leaving it to the last minute, like the day before deadline, that we're trying to still sort these out. If we can get as many of these sorted out before 30th of June, and sometimes it's just a conversation as how you're going to do it, and then you do the calculation afterwards, that's fine. Just please contact us. And then the new accounting standards, so 151058 for the not-for-profits apply this year, and 16 applies for everybody this year. So again, if you've not quite got on top of that, I think it's critical that you do that now before the 30th of June. Make that assessment now, reach out if you need assistance with it. When you've got it done, provide that information so we can look at that before 30th of June. That can all be done. The analysis of the leases can be done now. So let's get all that over with, so that when we do come to the year end, and when we're doing the final work at the year end, we've got all these critical parts that might have some complexities, but they've all been done. We've talked about them, we've audited them, and everyone's happy with the approach. So yes, a few differences this year, but we'll obviously perform our audits to the same high standard that we've always done. And if you do have any questions, please reach out. Just everything keeps changing all the time. So it's also important that if you do reach out to us, if you think you've got any questions about stuff that we've talked about today, because even with reporting deadlines, some of those might change in future. Who knows what's going to happen? So please keep in touch with that. And I'll pass over to you, Kim, if any questions.
Thank you, Aidan. It seems that our panelists have done a fantastic job of providing the participants with information, because at this point in time, we don't seem to have any questions. Would the panelists like to just maybe provide a final comment, or if there's something that you wanted to discuss at all?
Kim, sorry, the one thing I did not mention, for those listed clients that are listening, my understanding is that there's no change in deadlines for the Appendix 4E. So the ASX have left those deadlines as is. What that means is if you do not have audited numbers within 2 months from year end, you'll have to append your unaudited accounts to your Appendix 4E, and then lodge your audited numbers within the 4-month period. So just something I forgot to mention. Thanks, Kim.
No, thank you. Carmen, anything from you?
I think if I can just keep reiterating that it really is very much a depends answer in your financial statements, and every entity has to make that assessment on what that impact is going to be, what their balances are going to be. Unfortunately, there's no easy answer for me to give for those financial reporting impacts.
Okay, thank you. And anything finally from you, Aidan?
Just to remind everyone to communication, just keep us informed if there's going to be any delays, any questions you have. We'll be understanding of you because there's challenges for you, and we ask also that you're understanding of us as well, because we're all facing these challenges together.
Thank you. So this concludes our webinar for this morning.